Hi folks, Rick Wedell here. I'm the Chief Investment Officer at RFG Advisory in Birmingham, and today is Friday, April 3rd, and I thought I'd come to you with a brief market update to kind of let you know where we've come, where we've been this week, and what's going on today. As we speak, the S&P 500 is down about 1.25% to about that 2,500 number that we've been talking about for a couple of weeks now. And that really is kind of shocking for the week. If you look at the total return for the week, we're down about 1.5% to 2%, which is surprisingly stable in the context of recent history, at least. If you think about the fact that we were up about 18% in the last 3 days of the week prior, and down about 30% in the fastest market sell-off really in history prior to that. So still elevated volatility within the marketplace, but it certainly has felt a little bit calmer out there, although the VIX, or a measure of volatility, is still running at very, very high levels, around 50 right now. What's driving that? What's out there in the economic data today? Well, we've seen just data on the virus itself. Just like to remind everybody, there's a number of different viral trackers out there that do sort of modeled predictions of overall viral activity. I use one from the University of Washington. You can go online and pick whatever is your particular poison. However, it looks like peak virus cases in the U.S. will be sometime around mid-April, around April 16th to the 20th, will be peak cases and peak resource demand and really peak mortality associated with the virus. And then we're expected to start to see the numbers on the virus decline on the other side of that, which will obviously be a good thing. That's still a couple of weeks out, and so the news will get worse before it gets better, which is always challenging for financial markets. I think we're starting to follow a little bit what we've seen over in Europe, where the data is actually quite encouraging. Everywhere except the UK is starting to report declining infection rates, declining new caseloads, declining overall patient loads, declining mortality, which is good. It shows that the social distancing measures that we've started to take here in our own country should be effective as we continue them through April and probably into May. Starting to see even some calls for those social distancing measures to extend even further than that, but we'll just have to see where we are when we get to that point. In the meantime, the economic fallout from the shutdown continues kind of as expected. We got a jobs report for this week that showed about 700,000 lost jobs. That's really a trailing indicator at this point. Probably the bigger jobs numbers were the 3 million that we lost the week before and the 6 million that we lost earlier this week. That's about 10 million people that are out of work right now, which if you put them all in a single state would be, I think, either the 11th or 12th largest state in the United States. That's obviously a very large percentage of our workforce. Once again, it's not unanticipated. These layoffs have been known about, and they project that the unemployment rate will climb upwards of 13, 14, 15%. I've seen even some projections that are significantly higher than that. The good news is that once the virus is under control and the economy starts to heat back up again, hopefully those people can go right back to work again in some of the service businesses that have been effectively shut down by the virus. And that's actually what we've seen a little bit in some of the Asian economies that have started to come out of this is, I believe they've coined the term revenge buying on the other side of it to try and spend some of the money that they were unable to spend and I guess punish the virus, show that it didn't beat them on the other side of it. So we'll just have to see how that goes and flows. But in the meantime, the data that's coming out, while horrific in its magnitude, is not unexpected by the market, which you can see in the relatively mild movement of the market over the past couple of days as that data has come out. In terms of other news, the oil has been rallying significantly over the past couple of days. It appears that OPEC is going to meet via a virtual meeting on Monday, which is funny because we're all doing virtual meetings now. But OPEC is going to meet via a virtual meeting on Monday. It appears that Russia is now willing to consider production cuts. And that is something certainly that the oil market needs. So we've seen oil prices rally from a low of around $20 to the mid to high 20s, which is where they are today. Mid to high 20s certainly on an absolute level is not huge, but on a percentage basis is large. For those of you that know the oil patch, it's really got a double whammy right now in terms of significantly lower demand coming from just the contraction in overall domestic economic activity and global economic activity, combined with sort of a supply price war going on between the two largest OPEC members. That's a real challenge for that market because oil isn't something that's easily stored once you run out of storage capacity. So if we aren't using it, you can't just flare it like natural gas. You have to actually be able to put it somewhere. Some of the storage facilities are rapidly filling up, and there are parts of the world where oil is actually being selling for negative numbers, if you can believe that. The producers are actually paying the buyers to take it off their hands because they actually have nowhere else to put it. So it's nice to see a little bit of a strength and rally in oil prices. That gives a little bit of relief to the market. And hopefully we'll see that continue on into Monday. Away from that, I got asked a question around tax loss harvesting and what is that and what does it actually mean? So I thought I'd spend a couple of seconds here towards the end of the video just explaining that. I like to explain tax loss harvesting by explaining kind of the opposite, right? So if your financial advisor came to you and said something to the effect of, I've got a great idea. Every time you have a capital gain in a security, we should sell it so that you can immediately recognize that capital gain. You would look at your financial advisor and wisely say, that sounds like the dumbest idea I've ever heard of. I'll pay taxes when I don't need to. And the reverse of that is absolutely true as well. Whenever you have a security, particularly an ETF or a mutual fund, for which there are a wide variety of roughly equivalent substitute products, carrying a loss across any type of taxable year really doesn't make any sense. Recognizing that loss, even if that loss only sits on your personal balance sheet as a loss carry forward to be used in future years, is beneficial. It can help shield either current income, $3,000 a year, or future capital gains, be those from sold positions or be those from capital gains distributions from mutual funds or other investment securities. And so it really makes sense whenever you have that type of capital loss to go ahead and recognize it. The way that we do that is we sell the position where you have a loss, and we go out and buy a similar product, not exactly the same, but a similar product in the marketplace, hold on to it for about 32 days so that you can clear the IRS rules around tax wash sales. And then we'll turn around and flip you right back into whatever it is that you owned before. So you maintain your exposure to the marketplace, you maintain sort of a very similar investment profile, but you get the benefit of being able to realize that tax loss on your taxes, either in this year or in future years. So that's tax loss harvesting in a nutshell, and it's a great question, and thank you for sending it in. To the extent that you guys have any other questions or comments, please feel free, as always, to reach out to me or to your advisor. And I hope you have a great weekend, and I look forward to talking to you again soon.